Hello, everyone. I trust you're having a good day. Welcome to Fiducient Advisors first quarter 2022 capital markets update call. My name's Chris Kachmar. I'm a partner and chief market strategist here at Fiducient Advisors, and I'm joined today by my colleague, Rob Lowry. Rob's a senior research analyst with our global public markets team, and our intention is to spend the next 20 minutes or so just walking you through some of the bigger picture considerations from an investing perspective as the first quarter unfolded. We'll dive with a little bit more detail into capital market outcomes and returns, and then we'll also provide a little closing context from a portfolio perspective and on the positioning front as we move through the balance of the year. We have had a series of questions come in advance. Thank you for those. I think we've got our remarks prepared to address the lion's share of those questions. Of course, if you have comments or questions that remain unanswered, reach out to your consultant advisor. We're happy to help. And also the chat box function you can use as well, and we'll try to address some of those questions towards the end also. So with that, we're going to dive right into the content, and we'll start off with certainly an issue that has been pressing on investor psyche as the new year takes hold, and that's capital market volatility. And if you're measuring equity volatility with the VIX, or you're looking at certain measures of interest rate volatility, certainly we've seen very heightened levels of vol as the new year unfolds, somewhat consistent with where our expectation, as we'll talk about later. And really where that manifests itself for investors, of course, is from return outcomes. And you do see, as we've plotted here, a series of quarterly returns going all the way back to 1976. And in fact, you'll see in the lower left-hand corner of the page, really just 16 times where we've had both negative equity and fixed income returns. So it was, as we all know now, a fairly difficult quarter for investors. And of interest, I think, if you look in the lower left-hand corner, you'll see a couple of observations there relatively close in the neighborhood of the Q1 2022 highlighted outcome. Just to the northeast there is the third quarter of 1981. Just south of the 2022 observation is the first quarter of 1980. Interestingly enough, both those quarters were associated with the onset of recessions. We don't think that's the case for this particular set of circumstances, and we'll detail that momentarily. And then we would note as well, as you see depicted there in the upper left-hand corner of the exhibit, historically anyways, markets have found a path to stability and more constructive outcomes moving forward off these double negative incidents, if you will, like we encountered in the first quarter. The S&P up a little north of 9.5%, and the bond index, up close to 11% for the subsequent one-year period from these types of downdrafts. But volatility is elevated. We expect that will continue to remain the case, certainly for the foreseeable future. If we move, Ariel, to the next slide there, certainly a lot of discussion around economic growth prospects through the balance of the year. You'll remember we concluded 2021 with thoughts that the pandemic was largely abating and in the rearview mirror. We've had very strong, financially very strong consumers with lots of excess savings. We've had a lot of pent-up demand, as you know, and I think at the beginning of the year, forecasts globally for economic growth were pretty constructive, and you see those highlighted in the exhibit with the dark blue lines that run across the page, and pretty uniform expectations for decent growth. This is data from the UN, interestingly enough, and they tried to unpack the effects of the invasion and the crisis in Europe, and no surprises to the group, right? And the listeners, I would imagine that certainly there's headwind expectations for growth near term based on some of the circumstances overseas, and that will certainly press in the form of headwinds to economic growth. As we sit here today, looking through this type of data, looking at how resilient demand remains, looking at, of course, consumer financial health, we do think on balance that all things equal, that there's a greater probability than not that the economy will grow through the balance of 2022, just not quite at the pace first envisioned prior to the conflict. A final theme, if we move to the next page, I'm certain you've read about it, and something we've been monitoring on your behalf, of course, as we drew into the very end of the first quarter. The 2 to 10 year portion of the yield curve did in fact invert. That certainly garners a lot of interest from investors, right? Because they associate that inversion with the potential for recession. And that is certainly an outcome that we're mindful of. It is interesting to note, however, right, if you go back through time, and what we depict here on the page for you is just prior periods of inversion and what in fact is transpired on the heels of that incident. And a couple of things to take away, right? While there is some association of inverted yield curves with recession, the predictive power at the onset of inversion is a fairly weak one, as you see, and you see a full almost 2 years delay until the start of actual recessions from that point of inversion. And moreover, in the interim, you see some fairly healthy returns across capital markets, both equities and fixed income. So, inverted yield curves are certainly something to be mindful of. Rob will talk a little bit more about that in his comments, but again, not in our minds anyways, an immediate call to action in terms of meaningful changes to asset allocations. There's some big picture themes. There are a couple other things that we wanted to touch on before we transitioned over to market returns and some of the details there. If we could, Ariel, jump to the next page. Certainly, and as recently as this morning, of course, with the print you saw, inflation is running at very elevated levels. We have every expectation, given some of the supply chain indigestion, that pent-up demand remains strong, and all the things we've talked about will continue to be tailwinds to higher inflation and persistently higher inflation. The labor market, as we depict there on the right-hand side of this page, whether you're measuring wage growth or job gains month over month, which have been averaging north of 400,000 now for 11 months running, every indication, right, is we'll continue to have these pressure points on the prints for inflation in the coming months and quarters. So, and certainly there's some things we'll talk about on the portfolio level to respond to that. One thing of note, perhaps, as investors begin to process and evaluate prospects for inflation, you do see what we've done in the lower left-hand corner with 5 and 10 year break evens, and you see that growing disparity between the two time frames, and maybe some preliminary evidence, right, that investors are beginning the process of recalibrating expectations. And at some point here in the not too distant future, certainly not immediately, but in the not too distant future, inflation maybe begins to abate a bit and move back to levels that are more palatable from an investing perspective. While inflation is something we're mindful of and does certainly create some near-term indigestions in markets, as we've seen, we don't think it rises to the level that completely impedes some of the economic momentum that we've got, we think, going through the balance of the year. And then just a final point or two, if we could, on the idea of growth and our expectations there for the coming months and quarter. Another tidy way to look at economic activity in a nutshell, if you will, is using the leading economic indicators index, and we've plotted that for you in the lower left-hand corner of the page that is up. You'll note there that there has been recently some turnover and softening in that metric, but certainly not to the levels and the degree, right, that we've seen previously in front of recessions. And we've highlighted those recessions with the gray vertical bars for you, and you can see the magnitude of turnover in the LEI index before you start to see that real softening of economic outcome. And we have, as a suspicion that a relationship holds true for the near term as well. And then finally, we had just very briefly mentioned the situation in Europe. The humanitarian aspects, of course, which are atrocious, we'll set aside. Economically, as you've all read and I think have become somewhat accustomed to, in the largest grand scheme of things economically, Russia is not a particularly huge component of the world's economy. They certainly have tentacles in, as we evidenced there in the chart to the right, to the energy complex, particularly pressing into Europe, as you all know, into certain of the food and agricultural inputs, some of the metals markets, and those are things that certainly can be and will likely be disruptive and somewhat impede economic activity in the near term, particularly again in Europe, but not ultimately to the levels that we think derails Again, what our expectation is for a modest and decent economic growth, albeit a little bit lower than first envisioned, transpiring for the next several months and quarters. So those are kind of big picture takeaways. We'll come back and unpack some of this from a portfolio perspective momentarily. Rob's going to jump in here and give you a little bit more detail on capital market returns and influences. Rob?
Great. Thank you, Chris. So I'll briefly touch on some capital market returns across asset classes and then provide a little bit more color on the fixed income, equity, and real asset spaces. It was a tough, I'm not going to sugarcoat it, it was a tough quarter across asset classes for investors. You can see on the page, everything is pretty much negative. We start on the left-hand side, US core bonds, the Barclays Ag was down about 6%. It was the third worst quarter since 1976 for the Ag. So fixed income investors had a tough go of it as interest rates rose and credit spreads widened. Long duration, so more sensitive to interest rate movements, down about 11%. And then high yield, the credit sectors held in a little bit better, a little bit of extra yield cushion to offset some of that interest rate price movement. But overall, a pretty negative environment for fixed income investors. If we shift to equities, US large cap was down about 5%, slightly edging out US small cap space. US large cap companies tend to do a little bit better and protect a little bit better in risk off environments compared to their small cap counterparts. And then abroad, international developed, just edging out emerging markets suffering from a few factors, Russia being a big one with the conflict breaking out in Ukraine between them and Russia, and then China, a big factor as well. And we'll see that return in a bit, but further COVID lockdowns and restrictions there, as well as a crackdown on the regulatory front, hindering those results. A couple of bright spots in a dark room, the real asset space up 1.6%, so modestly positive, providing a nice cushion and providing that association with inflation. And then commodities really benefiting from the energy sector. And we'll get into more details in a minute to touch on commodities, but up 25% for the quarter. If we go to the fixed income markets, we can take a little bit deeper dive. Interest rate movements were the biggest driver here. The US 10-year yield rose about 80 basis points for the quarter, going from 1.52 to 2.32. That was really ahead of the Federal Reserve's and in anticipation of the Fed starting to raise hikes, which they did in March. They rose their Fed target rate by 25 basis points. That trend has continued through April. So the 10-year is up another 45 basis points, up to about 277 as of yesterday. That was on the back of the release of the Federal Reserve minutes from last week, really indicating that the Fed is willing to take a little bit tighter policy, willing to take 50 basis point rate hikes here and there if needed. So some market, and then the high inflation print from this morning at 8.5% driving that as well. So further rate increases so far in Q2, and it's been a tough environment for fixed income investors. That said, starting yield is a pretty good predictor of future returns for the fixed income market. So, while we've had this short-term negative impact and we've felt it for sure, a starting yield at 277 on the 10-year, and if you tack on a little bit more for credit and extra alpha, hopefully for managers, you start to paint a much better picture for future fixed income returns going forward over the long term. So, almost to the point where we can get a real return should inflation come back down to more reasonable levels over the next 10 years. Ariel, if we go to the equity page, I mentioned valuations, prices came down really across the board. Earnings were pretty resilient, so that resulted in equity valuations moving lower across regions. You can see that the green dots there being at the end of the first quarter compared to the gray dots at the end of last year, and really came down across regions. International developed and emerging markets now trading at or below median levels, so relatively attractive opportunities there from a valuation standpoint. And the US continues to remain slightly elevated, now within that one standard deviation range, but still well above the median level, but obviously trading at higher absolute and relative valuations compared to international and developed. So, our long-term views remain the same from a strategic allocation standpoint. We continue to have a slight underweight bias to the US in favor of international and developed emerging markets relative to the global equity opportunity set. And these aren't extreme positions by any means, but just modest tilts here and there. We're mindful of geopolitical events abroad and at home, and the potential for a slowdown in economic growth, et cetera, and what that means for the U.S. and international. And at this point, I don't think we're ready to make any tactical decisions to overweight or underweight U.S. or non-U.S., but on a short-term basis. But we continue to have that long-term strategic view of a slight underweight to the U.S. equity market compared to the global opportunity set. I hinted at it earlier, but if we flip back quickly, Ariel, just to the country returns, I think a couple of standouts here. Really negative across the board. Really, China, that negative 14% was a tough quarter for them. But Canada and the UK, just some interesting opportunities, and we saw some positive returns there. The underlying construction of the benchmarks, a pretty big factor in kind of what those markets are made of. So Canada and UK have pretty heavy chunks to equity and material, or energy and materials. Energy is about 15% of the Canadian benchmark and 12% of the United Kingdom benchmark. Materials adds another about 10, 11, 12% there, depending on the region. Conversely, so really strong results, benefiting from the commodity price increases there. Conversely, the US is about 3% energy, but 30% information technology. And we saw high PE, high growth names really sell off in the first quarter, so negatively impacting that tech space, while Canada and the United Kingdom have about 10% in technology and 1%, so less impacted by that sell off in the high growth and PE names there. And then finally, if we go to the real asset slide, Ariel, we'll just touch on it briefly, but the energy market up almost 50% for the period. Energy prices soared, really oil being the big driver there. It crossed $120 a barrel through the quarter before falling back a bit towards $100 towards the end of the quarter. And then industrial metals, precious metals, agriculture, all really gaining price momentum on the back of the global supply chain and shortages there and the disruption there. And then the conflict between Ukraine and Russia continues to put pressure on prices higher. So the commodity market really benefiting that. The real estate market, on the other hand, especially REITs, kind of fell in lockstep with the broader equity market in the risk-off environment. A couple of notable standouts here: higher PE, higher growth names. It's kind of similar to the broader equity market. Sold off a little bit more than the rest. So data centers, as an example, was down about 14%. They tend to have longer lease terms, so they were a little bit more negatively impacted by the rising rate environment as well. But then a couple of bright spots in areas that we've seen that have really struggled over the last few years. Return to office seems to be picking up again this year. So the office space up about 3%. And then consumers are continuing to travel and starting to pick up their travel and vacation, et cetera. So the lodging and resort space benefiting from that at about 7%. All in real assets, as we had pointed out earlier, up modestly, up 1.6%. A nice diversifier in portfolios, a nice benefit there as inflation was higher, and a good diversifier across the equity market and fixed income market. Overall, again, as just a quick recap, broadly speaking, asset classes were negative across the board. A tough environment for fixed income investors as interest rates moved higher, the risk-off sentiment and inflation and Fed expectations pushing equity markets lower, with real assets and commodities kind of the few bright spots in the room. With that, I will turn it back to Chris for some concluding remarks.
Thanks, Rob. Just trying to bring together some big picture considerations and then some individual observations with respect to capital market outcome. So we trust that was worthwhile for folks. Kind of coming full circle, just in terms of concluding thoughts, for those of you who saw our 2020 outlook piece, largely kind of remain unchanged in terms of we have ongoing expectations for more modest returns, and we expect that the volatility that's elevated, that has been elevated, will remain so for the foreseeable future. So no big changes on those fronts as the year begins to unfold and season. Importantly, I think for those of you in your conversations with consultants and advisors at the beginning of the year, we had talked about, and Rob hinted at this a little bit, kind of two orientations where we thought some opportunity on the margin anyways, and that's centered on a recognition, right, with more volatility, more rate volatility, and all things equal, perhaps interest rates grinding higher, a desire to step away from some of that duration risk, and doing so with things like flexible and dynamic fixed income strategies. And given the landscape that Rob described, those stances, for those of you who executed there, have proven to be very accretive to positioning versus what's gone on in the broad fixed income markets. And then moreover, right, we were already seeing obviously elevated inflation and then some as the years progressed, and steps into thoughtful, diversified, and kind of well-construed allocations to real assets we thought was a winning hand as well. And fortunately, both of those two stances have proven to be generally additive to client portfolios year to date. And we continue, as we sit here today talking to you, think that there's merit to holding those positions for the time being as well. And then finally, the very highest level, big picture, certainly all this content and perspective we hope is useful. It really always comes back, as you know, in talking to your consultants and advisors about your portfolio's objectives, ability to bear risk, and positioning accordingly. These more volatile times are often very worthwhile times to reinvestigate your strategic intents and your ability to bear risk. Looking for opportunities perhaps to rebalance into some of this volatility can be a useful long-term exercise as well. And really perhaps goes without saying, but volatile times as well being a good time to really fully embrace the benefits of diversification for your portfolios, right? And that runs both at the asset class and at the manager roster levels. That's a kind of a powerful defense that you have a wherewithal to in some of these more volatile times. So it looks like we're running at just about 22 minutes or so. So we have a minute or two more. Rob, I did see a question that related to the Fed's kind of efforts on the interest rate front. How many hikes are priced in? Are they kind of poised to follow through on what the markets is expecting? And if you've got any general observations on that front.
Sure. So, the Fed raised their rate for the first time since 2018 in March. So the target rate now currently is 25 to 50 basis points. I checked this morning with the high inflation print. Markets are now pricing in about a 85% probability of a 50 basis point rate hike in May. And given what the Fed has said in recent language that they're open to those type of hikes, it wouldn't surprise me if that gets fulfilled. And then if we look out to the end of the year towards December, the market's pricing in about a 50%, greater than 50% probability that the federal funds rate will be between 2.5% and 2.75%. So if we back that out on 25 basis point levels, it's about 9 more rate hikes through the course of the year. It's hard to handicap how many we'll actually get. And I think there's some driving factors. The Fed's going to be very data dependent, obviously, with their dual mandate of maintaining inflation and full employment. But, based on those two factors, with the strong job market and the high inflation print this morning, the data is there to be supportive of further rate hikes. Where we're going to get into where maybe we don't get to that 9 level that the market's pricing in currently is just what's going on with the yield curve and geopolitical events and the economy. So it's really hard to handicap. We've got a really flat yield curve. I think the Fed's going to be cautious in terms of, raising rates fast enough and really hiking us into an inverted yield curve. But that said, there's still room on the very front end of the curve where that would be most impactful for room to raise rates there. And then, geopolitically, with events abroad, potentials for slowdowns, but still positive growth in the back half of the year, that may temper the Fed's willingness to do further raise. So, my politician answer is somewhere between 1 and 9, but it probably falls somewhere in the middle of that range.
And I see one other question here. It relates to the prospects for stagflation, right, which has kind of come back into investor lexicon here, and certainly something to be mindful of, right? You've got some elements of that in the form of, high inflation, but you've got moderating economic growth. But again, we don't have expectations for a recession just yet, kind of a necessary, leg on the stool for full-blown stagflation. So we don't have immediate concerns on that front just yet. but certainly something that we're monitoring closely. So it looks like from a question perspective, at least from what I'm seeing on my screen, we've kind of attended to everything. Again, if you've got questions beyond that, and we haven't answered them, reach out to your consultant or advisor. We'll get you that information back. We certainly appreciate your time and attention today. We hope that you found the time productive. As always, we'd encourage you to visit our website where there's lots of new and fresh content and perspectives being loaded all the time to keep you updated on things going on in the markets. And with that, we'll bid you a good day and enjoy the rest of your week. Thank you.